Right. The reason your business works is because of the people you've got in your business. The business are not worth a hang of a lot. As soon as you start adding people, things start working. Now, the only reason what your people need is both cash and time. And again, please, we'll go into these in more detail in future sessions, but just bear with me as we get through this. What your people need is also resources, toys to play with, so that they can actually do your business. And where you get cash is from your customers, and why you get cash is because you sell product. Now, the question is how these connected, and basically those arrows will show you the connection as I see it. And what's important is what connects them, and fairly obviously, what connects them is that cash through your bank goes to your people then buy product or resources. Your resource, the package, etc., your product. You then sell your product to your customers, they pay you, and the money goes back in the bank. So, fairly obvious, fairly simple connection. However, the core of your business success, funny enough, is buying. It's not anything else. Most people think the sharp end of business is selling. Selling is not the sharp end at all. Because if you don't buy the right stuff at the right time with the right quality for the right price, there's no ways you can sell it. So buying to me is probably the most important thing you need to get right in the business. And then you also need to know that this all works. Now what I mean by knowing is that you need to make sure that your process of budgeting and reporting is in place. Because if you haven't got some sort of plan in terms of how you're going to perform and you don't report on how you're performing against that plan, you don't know what's going on in your business. So let's have a look at what you need to know when you budget and report. On the resources side, you need to know the utilization of your resources. Now remember, your resources are things like your vehicles, your buildings, all that sort of stuff. So when you budget, you need to know the level at which you expect to use these resources and decide on the best measure for that resource. Now, silly examples, building percentage occupancy is a good measure. Manufacturing equipment, weekly output or quantity of output per week is a good measure. So it's not the same measure for every resource that you have. And then when you report, you need to know what's underutilized, overutilized, and properly utilized. And fairly obviously, once you know that information on 3 separate reports, the properly utilized one, by the way, you just fire, you don't even look at. The decisions you can make on the underutilized stuff is you know what, you utilize it more at another shift, upgrade the technology, whatever. And overutilized decisions are very simple. You also upgrade the technology, perhaps buy more of the stuff, and those sort of decisions. When you get to product, the question is, how long do you expect to hold the product before it's sold? In other words, you're measuring the age of the product. Easy example here is sort of stuff on the shelf of a supermarket. It makes sense that a supermarket has a measure that says something like, if we put a can of baked beans on the shelf, it should stay there for between 4 to 7 days before it's sold. That's a good budget for product. For services, slightly more complex, but I'm not going to deal with that now. Again, 3 reports. What's slow moving, what's moving properly, what's fast moving, the stuff that's moving properly, file it, forget about it. Slow moving stuff, perhaps we should reduce the price, put it in a better place, buy less of the stuff. The fast moving stuff, buy more of it, charge more, and so on. If we look at customers, again, you measure age. When do you expect the customer to pay? Obviously based on their credit terms. And again, 3 reports, early payers, slow payers, and paid on time. The guys who paid on time, you print and file, you don't even look at it because things are going right there. Early payers, you phone them and thank them, and then you find out why they paid early. Funny enough, 90% of the time I find people pay early because they don't want to speak to you again. In other words, you've really made them angry, and now they're saying, you know what, let's just get rid of this. Like I say, it doesn't even phone us for the amount we owe. Sometimes, however, very rarely, they pay early because they like you, because you've done everything right. Always nice to find that out. On the slow payer side, there's always lots of excuses. The biggest one is cash flow. And again, you have an agreement with these people. You supply product, they pay you according to an agreement of their credit terms. And if they don't want to pay on time, what you do, what I'd recommend you do is close their account, don't even let them buy on COD. And say to them, once you've paid your account, we can renegotiate your terms, which are going to be a lot worse than they are at the moment. So those sort of decisions are easy to make when you measure that sort of stuff. On the cash side, you need to know what the future looks like. In other words, you need to know how much money you're going to have in your bank in 3 weeks or a month or 2 months' time. So cash flow forecasting is a daily activity that you need to carry out and look at least 3 months into the future. And you need to report not only your current account, in other words, how you see it over the next couple of months, but also your investment accounts, which is your spare cash that you can use to back up your current account. And then your capital expenditure, which is where you utilize spare cash when you've got spare cash. Because when you grow a company, the trick is to grow your equipment that produces the income, or the product that produces the income. Again, a lot more detail needed on this, but I'm not going to spend time on that now. And then the last one, and the hardest one, is how do you make your people happy? Now, this is not reporting. This is, you need to put systems in place, because there are two big problems. Communication, the biggest problem in any company. And secondly, loyalty. And by the way, by loyalty, I don't mean loyalty by the staff to the company. I mean the other way around, company to staff. So on the communication side, I have two solutions, cross-mentoring and job swapping. Very quickly, cross-mentoring is two people of an equal status or level within a company talk to each other, and there's a system behind that as well. And job swapping is a vertical thing where two people who are at very different levels. And the example I often use is managing director, security guard. They swap jobs for a day. Now, they don't swap jobs. They actually spend a day with each other, half a day doing one person's job, half a day doing the other person's job. Just so that there's a huge amount of empathy developed in terms of what's going on with every individual within your company. These things obviously are done on an ongoing basis. They're not just some of once-off. Cross-mentoring, I recommend every 6 months you're cross-mentoring with someone, and you have very few meetings, but those meetings are very directed. And the job swapping occurs about once every 6 months for a full day as well. On the loyalty side of things, again, remember the company needs to prove its loyalty to the staff. Therefore, I strongly recommend succession planning. Now, that doesn't mean everybody's going to be managing director. What it means is that you have a plan with every individual you work with as to what their future looks like, and that's decided between you and usually by them alone. And your job is to help them get there through education, experience, or whatever means you find necessary to help them get there. One of the examples I have is a young lady who worked in a call center, wanted to be a chef. And under my recommendation, the company sent them to a hotel school. And she stayed with them a hang of a lot longer than she would have had she just been a call center agent. And she ended up one of the most successful employees they ever had. So again, the trick is to develop empathy. Anyway, there's a lot more detail on this, which will come up in the next couple of weeks. So what about the processes? How do these fit together? There they are. You sell, buy, and bank. And again, no time to explain all of this, but there's the sequence in which events occur within a company. Every company, everywhere in the world, no exceptions. And you'll see the selling starts off with an inquiry, works its way down to a receipt. The buying starts off with what do we need to do, and ends up with a payment. The payment and the receipt end up in the bank, which we reconcile. And then in order to report, we do a stock take and a whole bunch of management reports, which a lot of them come out of what I've spoken about earlier. And again, there's a lot more information here that needs to be covered. So this is where we started. That's how everything fits together. Now, that's great when you're running a company. My big problem is an awful lot of people have never planned their companies. And again, the trick here is don't plan your company. Plan each product in a way that will come up now. This is just a thing to say to people, where do you really need to start chatting? And these are the most important things to chat about when you're running a company. So there's how the thing fits together. And if you want to plan it, that's how it works. You start with your product and you work your way around in a different sequence to what you manage your company.